Hey everyone, Bowen from Enhanced Asset Management here. Just back with a quick update today on some new direct share positions within your portfolio. It's obviously been a pretty volatile month or two in financial markets, and we're now starting to see some opportunities to add value to your portfolio outside of the index. So we've taken a few positions to start with now. The first one we'll run through today is Aussie Broadband. So Aussie Broadband is Australia's fifth largest broadband services provider, and their market share is continuing to grow. So they now make up 7.8% of the NBN market in Australia, and that's up from 7.4% in June. So I guess the thesis on this one is they've just released a third quarter trading update, and it showed their best organic growth quarter for over 3 years. And they've now also got a new telco brand called Buddy, which is aiming to target some of the lower cost customers that perhaps their core business is missing. They've also released some new FY28 targets, and these include group revenue of $1.6 billion. This is around 200 million higher than we had originally forecast, at a margin that we had plugged into our model as well. So, you pair that additional revenue with the same margin, and you're going to get a much higher earnings outlook, and that is what we've got in our valuation. Also worth noting that they're expecting their NBN market share to be up over 11% in FY28, which is another 3.2% from where they're at now. Really strong growth. And on our valuation metric, we model out Aussie Broadband's after-tax cash flows over the next 5 years, and that produces us with a valuation of $4.57 per share, which is around a 19% upside to the current price. So you can see, even in the market volatility, Aussie Broadband has actually held up pretty well, and with a $4.57 price target on this one, we can see the chart's heading in the right direction, and we expect to see some good performance moving forwards. The next one we've got is Ansell. So Ansell's a global leader in personal protective equipment, or PPE, and they specialize in the industrial and the healthcare space. So a lot of protective gloves and hazmat suits and all that sort of thing that you'll see in the healthcare sector. Now, the half-yearly result was extremely strong, and we saw sales up 12.5% organically, and the operating leverage that they were able to produce throughout this result was really fantastic. So despite only growing the top line at 12.5%, some good cost control allowed them to grow their earnings per share by almost 34%, which was extremely strong. So this one's been on our radar for a little while, and it's taken a bit of time for it to come back to a valuation that makes sense for us to take a position. And this was off the back of a tariff update, which there's obviously a lot of companies that have been going through something similar to this. But 43% of Ansell's revenue is generated from the US, with a majority of the products that are sold in the US are sourced from suppliers in some Southeast Asian countries. So when Donald Trump initially came out with his reciprocal tariffs, some of these countries were upwards of 40% tariffs: Vietnam, Sri Lanka, Malaysia. And we saw a pretty significant sell-off in the share price for Ansell. Now, even with these significant tariffs in place, they were pretty confident that they would be able to pass on a lot of these pricing increases to their customers, and they retained the guidance at the level that they had previously announced, so no change, which was obviously a really good result. Now, since then, we've seen Donald Trump come out with the scale back of those tariffs, and now we're only going to be seeing 10% tariffs in these Southeast Asian countries, which should allow, obviously, Ansell to be in a much stronger financial position. And our valuation for Ansell comes in just shy of $40. So with the sell-off that I'll show you on the chart here shortly, it shows around a 36% upside to the current price. Now, as we said here, at the start of April was when the Trump announcement came through, and we saw a pretty significant sell-off in Ansell's share price. So we still haven't seen much of a bounce from the share price, which is a little bit surprising to us given the significant scale back of the tariff announcement. So we're pretty confident taking a position here, and expect to see that share price up over $35 in the short to medium term. Third position we've taken is a Adelaide-based business called Codan, which I'm sure a lot of you might already be familiar with. And they started off as a a metal detection business, and they're global now. Their global brand, Minelabs. However, in more recent times, Codan has been diversifying their revenue into the communications and the technology sectors through a few acquisitions. Some notable ones include Zetron, DTC, and more recently, Kagwerks. So now, instead of just being a metal detection retailer, they provide surveillance to law enforcement. They specialize in military communications and law enforcement communications as well. So a very diverse business now than what it was perhaps 5 to 10 years ago. The first half for Codan was extremely strong. They grew revenue by 15%, and EBIT and EPS were up over 20%. Now they have guided for 10 to 15% organic revenue growth within the communications sector, and they exceeded this comfortably throughout the half, and they expect to exceed this for the full year as well. So everything's trending in the right direction for Codan, and we've had this one on our radar for a little while now, and it's nice to see the share price pull back to a level where we can comfortably enter a position. So our valuation for Codan comes in just shy of $16.50, which again, given the pullback we've seen recently, now represents a bit of upside, just over 14% to the current share price. And as we spoke about there, you can see a pretty big pullback, particularly from the Feb market highs, and the share price has started to bounce. It dipped a little bit below $14 last week, and it's bounced back up pretty nicely, and we're pretty comfortable taking a position here with a expected 14% upside. And the final one, which we've just only added today, is a small company called Zipco. So they're a financial services company, and they offer some pretty innovative products, which are all centered around buy now, pay later services. Now, Zip has been in the news for probably the last five years since COVID, when the share price really took off, and it was a completely different business back then. They were, trying to grow globally, making lots of acquisitions, just trying to grow their top line without really, factoring in how sustainable that was and how much their cost base was blowing out. So we saw post-COVID, when spending slowed down, Zip got themselves into a lot of trouble. So I think their share price touched $12, and for most of 2023, the share price was sub $1. So they've been on a bit of a tumultuous period. However, late 2023, they appointed a new CEO, Cynthia Scott, and she's done a fantastic job turning the business around to where they are today. So they've been really focused on the US and Australia. They've cut out all their other international markets. They've just dialed in on what they were doing well, and that was in Australia, and they've dialed in on a key growth geographical location, being the US. So early and significant addressable market growth within the US is kind of the thesis here. So buy now, pay later make up less than 2% of the total payments market in the US, whereas Australia, it's a much higher figure. So with the US going cash fading out within the US, and they're getting more digitally enhanced, we can see buy now, pay later really taking off in the US, and Zip are perfectly positioned to leverage on that. So as we spoke about, US has been driving the growth, and you can see that the transaction growth here on screen. They've grown from $900 million back in the first quarter of 2024, all the way up to $1.6 billion in the second quarter of 2025. So some extreme growth. That's almost double the transaction value in just over a year. So, we can see those trajectories continuing, and their outlook for the US and for their Australian business is extremely positive. Our valuation on Zip, we produce a valuation of just under $2.40, which at the current share price, following a pretty significant market sell-off, represents close to a 60% upside. We understand that Zip's a smaller company, and there's probably going to be a little bit more of a volatile ride here. So we've taken a slightly smaller position than the other three, but we think the upside here is enormous. And, if they can execute on what they're trying to produce, then, that $2.40 target can be hit pretty comfortably in the next year. So speaking of the big pullback that we've seen, since the start of the year, the share price has basically halved. And basically that was just on some numbers that slightly missed analyst expectations, which was still some extraordinary figures, and the business is growing extremely strongly. So we're pretty confident that as if we'll be able to turn this share price around. They've just started conducting a share buyback, which again gives you a lot of confidence in management, thinking that the share price is clearly overdone. And you can see a nice little bounce there from around $1.25 up to $1.50. And as I said, our valuation is relatively conservative, and we can see this one being worth upwards of $2 pretty comfortably. Now, as always, this is general information and is not financial advice. We will keep you updated over time as we look to add more things into the portfolio, and we see hopefully a pretty strong recovery in the Australian share market. Until next time, I'll chat to you later. Bye.